We're here today to talk about diversification. Diversification is really the next step after you've gone through asset allocation in developing your investment management strategy. You've heard the saying, don't put all your eggs in one basket. Essentially, that's what diversification speaks to. So when you think about asset allocation, we're basically breaking down your portfolio into three categories. There's more than three, but the three core are equities, fixed income, and cash. Diversification is a function of going back to each of those categories and breaking it down even further so that we're managing risk more effectively. Okay, and that's a key component. We want to manage for growth, but we never want to put all our eggs in one basket. So when we go to the equities bucket, we break it down between large size, mid-size, and small size companies. It's called large cap or large market capitalization companies, mid cap, small cap. From there, we divide it between growth-oriented companies and value-oriented companies. These are companies that may have been around a little bit longer, and they're at the point where they're sharing their profits in the form of a dividend with you. Growth companies typically do not do that. So when you take that allocation to equities, the stock side of your portfolio, you may put a percentage in large growth, and maybe it's an equal percentage in large value. There's a third, what I'll call middle asset class, which is the blend category. And blend basically means it's a blend of growth and value. And then we break it down between US-based companies and international companies. On the international side, we have developed countries and we have emerging markets. Emerging markets are riskier. We don't want to overweight, per se, emerging markets. So in summary, on the equity side relative to diversification, you're breaking down that equity allocation into large, mid, small, growth, value, and international. On the bond side, it's a little different. We look at the credit quality of the issuer of the bond. So there's investment grade bonds and non-investment grade bonds. And we also look at the term of the bond. Is it short term, intermediate term, or long term? So that's how you typically would diversify the bond side of the portfolio, but that's not quite as important as it is to, in terms of diversifying the equity side. On the cash side, it might be your stable value fund or some kind of money market fund. But by spreading things out the way I just defined, you are now managing risk in your portfolio more effectively.